If you are looking for last-minute strategies to reduce the taxes you owe for the prior tax year, or even increase your tax refund, then look no further. In this video, I'm going to walk you through the top retroactive tax strategies that you can apply to your prior year tax return, even though the tax year has ended. And trust me, these are strategies that your accountant may not have shared with you yet. So even if you have already filed your taxes, after you learn these tactics, you might even consider amending your tax return because these things could put money right back into your pockets. So as a licensed CPA that tax plans every day at mycpacoach.com, I want to walk you through each of these, so let's jump right in. Okay, so let's start with the most time-sensitive strategies, like number one, IRA contributions. If you did not contribute to an IRA for the prior tax year, you still have until April 15th of this year to make a contribution. And here's the best part. If it is an eligible traditional IRA contribution, then you can claim a tax deduction for the amount that you put into that IRA for the prior tax year. For example, let's say you're 45 years old. Well, you could go to a place like Vanguard or Fidelity and set up a traditional IRA for free and put upwards to $7,000 of your earned income into it. And when you do, you could get a $7,000 tax deduction. Plus, if you have a spouse, then they too can also take advantage of this. So let's say you and your spouse put $14,000 into this account. Well, at a 22% tax rate, you would save over $3,000 in taxes. Now, if you or your spouse is covered by a workplace retirement plan, then you may be subject to some income limitations, which may impact your ability to write off these contributions. So be sure to look into those rules if that applies to you. Now let's move on to the next big retroactive tax strategy. Number two, the HSA. So if you have not maxed out your HSA or health savings account for the prior tax year, then you have until April 15th to do so. In 2024, the HSA limits were $4,100 for taxpayers with individual coverage only and $8,300 for those with family coverage. And the only requirement to qualify for an HSA is that you have to have a high deductible health insurance plan, which was defined as having a health plan with a $1,600 minimum deductible for individual coverage or $3,200 for family coverage in 2024. So if you met those requirements, then you may be able to open and fund an HSA before the tax deadline to reduce your taxes. For example, an $8,000 contribution to your HSA would reduce your taxable income by $8,000, saving someone in the 32% tax bracket over $2,500 in taxes. But that's not it. You can also use strategy number three, self-employed retirement plans. So if you're self-employed or an independent contractor or earn 1099 income, this is another huge opportunity to reduce your taxes. You can set up a retirement plan like a solo 401k or a SEP IRA for the prior tax year. And you have until your tax extension deadline this time, which is either September 15th or October 15th, to make contributions to these accounts as an employer. This gives you extra time to fund these accounts and significantly reduce your taxes if you file an extension. For example, let's say your business earned $100,000 in 2024. Well, each of these accounts would allow you to contribute up to 25% of your compensation into a SEP or solo 401k, which will put up to $25,000 of your business income towards your retirement, saving someone about $8,000 who is in a 32% tax bracket. Now, in order for your contributions to be tax deductible, your plans must be structured as a traditional or pre-tax retirement plan, not a Roth, which you should weigh carefully if you're considering the two. And also, these late contributions are generally only allowed for the employer's side of these limitations, not the employee deferral. Okay, so we've already talked a lot about moving money to different types of accounts here, but there's things that we can do outside of those accounts as well. So let's move on to strategy number four, the late S-Corp election. I have clients who save tens of thousands of dollars in taxes from this alone in a single tax year because the tax law allows you to go back up to 3 years to implement this. So let's break this down. So when you earn non-employment income, like business income, 1099 income, income from a side gig or side hustle, and so on, usually you are subject to self-employment taxes. And these taxes are generally equal to 15.3% of your self-employment income or non-employment income. But guess what? S corporations are not subject to these taxes, not directly anyway. So to reduce these taxes, you can follow the IRS late election relief rules, which may allow you to classify how you want your self-employment income to be taxed for those prior tax years, potentially saving you thousands of dollars in taxes. For example, let's say you earn $150,000 in self-employment income as a disregarded entity. Well, this would subject you to about $23,000 in self-employment tax. But if the IRS granted you late S corporation relief and instead taxed that income to you as an S corporation, then you would instead save about $23,000 in those types of taxes. Now, there are several rules and requirements you must meet to successfully accomplish this, so just drop a comment below if you want to learn more about that. But we still have more tricks in the bag here. So let's talk about another big strategy that you can retroactively apply to a prior tax year. And number 5, depreciation. Now, this is big for taxpayers that own a business or investment property. And as a CPA, I often see people miss this very easy deduction. So if you don't know, depreciation is a non-cash expense that you can deduct that allows you to write off the cost of property you own over time. And you can take very large depreciation deductions depending on the method you use to calculate it. And there are several. There's straight line depreciation, double declining balance depreciation, bonus depreciation, section 179 depreciation, and more that you can use to take very large tax deductions on your returns to reduce your taxable income. For example, section 179 allows you to depreciate up to 100% of tangible assets in one given year for qualified purchases up to $1.1 million. So if you bought $10,000 of equipment, for instance, you could write off the entire amount in one given year, saving someone $3,200 who is in a 32% tax bracket. So if you own investment or business property, check your tax returns to see if you're missing depreciation deductions. And if you are, make sure you find out the most beneficial methods to use to reduce your taxes accordingly. Now, outside of depreciation, you may also depreciate from number 6, the QBI deduction. Now, most people have heard about the QBI deduction by now, but many people miss this deduction when they actually qualify for it. So if you don't know, the QBI deduction is a freebie 20% tax deduction against qualifying business income. So someone with $150,000 in business income would get a $30,000 tax deduction with this. But this deduction is not automatically applied, so you have to check for this. And to further complicate this, many people, including many accountants, misunderstand the eligibility requirements. So in 2024, single taxpayers with incomes below $192,000 automatically qualify for this tax deduction. And married taxpayers with incomes below $384,000 automatically qualify as well, which means if your adjusted gross income after subtracting all of your deductions fall below these amounts on your tax return, then you should be able to take a 20% QBI deduction against your business income. A lot of people get this confused because specialized service, trade, or businesses are generally excluded from taking the QBI deduction. So people like doctors, lawyers, accountants, financial advisors, and other professions where the outcome or result is largely based on the employee's skill providing a service are typically excluded. But these same businesses can in fact take the QBI deduction if their incomes are below the thresholds we just went over, and they do not operate as a C corporation, which many people do not. So be sure to check this, and while you're at it, it's also important that you implement strategy number 7 here. Find all missing tax deductions that you may be eligible for. Take a look at your largest expenses that you even personally incurred during the tax year and see if there is any way for that expense to be deducted on your tax returns. A lot of people think that they can only write off things with the itemized deductions. So things like charitable contributions, state and local taxes, and medical expenses. But no, there are ways to write off portions of your home expenses, car expenses, travel, meals, healthcare, childcare, and so much more. And if your accountant is not helping you with any of these types of things, then just go to mycpacoach.com to apply to work with my team of CPAs today.